Hey guys, today we step into the bustling energy of market tickers, scrolling across glowing screens, traders leaning forward in their chairs, coffee mugs steaming, and a sense of possibility humming through every pixel. But here's a reality check. Most people treat the stock market like an exclusive club they'll never qualify for. A place where you need insider tips or a millionaire's bankroll just to glance at the guest list. Through this journey, you'll learn how to treat stocks as a friendly neighbor in everyday life, not a fortress behind velvet ropes. How do you build real wealth with stocks? Many assume the secret is insider tips, magic formulas, or starting with a pile of cash. That's not it. The real driver is embracing stocks as part of your daily routine and mindset, as natural as buying a coffee, commuting to work, or putting money aside for bills, and seizing small, consistent steps that add up to something big. You wake up, check your phone, and see the same apps you use to hail a ride or order dinner now offer a way to own a slice of your favorite company. You click a button, not because you're chasing the next hot trend, but because you've automated a habit of saving and investing. In that moment, stocks become an extension of you, a tool you wield thoughtfully, rather than a distant, intimidating giant. It starts simple. You divert a fixed amount each week from your paycheck into an index fund or a handful of carefully chosen shares. You don't need to worry about timing the market because you're treating this as a steady march forward, not a sprint or a gamble. Over time, these small deposits grow roots underground, unseen, until one morning, you realize your balance has doubled, tripled, and beyond. You've built wealth without midnight panic or frantic trades, just everyday discipline. Imagine a friend who buys a coffee every morning without a second thought. Now picture that same friend buying a fractional share of a proven company's with that same small amount. Over decades, those tiny purchases blossom into a garden of ownership that dwarfs the coffee budget. You don't need to feel guilty about the latte. You can adjust the routine without giving it up entirely. The point is consistency. Of course, you'll hear skeptics. You can't beat the pros. The market's too risky. Only the rich get richer. Those are myths, echoes from a bygone era when investing required a special license or a seat on Wall Street. Today, anyone can open an account on a smartphone in minutes, with as little as $10, and join the game. The old barriers have fallen. The new frontier is psychological. Your challenge is to shed the belief that stocks are only for other people. You see, when you treat stock ownership as a normal part of life, you normalize both the ups and the downs. You won't panic when markets wobble because you've built the habit of staying the course. You won't chase every sparkling headline because your mental model is grounded in patience and compounding. And you won't wait for permission because you realize that ownership is a right, and not a privilege. I know it might feel odd at first, like you're poking around in territory reserved for experts. But remember how you felt the first time you ordered groceries online or set up a bank transfer on your phone. The more you do it, the more natural it becomes. That friction you felt dissolves, replaced by confidence. Before long, the idea of owning stocks is no more intimidating than maintaining your checking account. This shift in mindset, and from spectator to participant, is the foundation for everything that follows. You're not trying to outsmart the market. You're aligning with it. You're not gambling on a single punch card ticket. You're planting seeds for a future harvest. And you're doing it on your terms, at your pace, with your resources. So take a deep breath, lean back, and picture yourself years from now, grateful you started when you did. The tickers still flash, the voices still chatter, but you're no longer outside looking in. You're part of the story, and every small step you take today fuels the journey. You lean forward as the ticker symbols flash across your screen. Each price tag a story waiting to be told. But what if the story you're reading is misleading? You see Amazon trading near its peak, its headline-grabbing growth tempting you like a siren song. You feel that thrill, that buzz of possibility until the market swoons and your gains evaporate overnight. That's the danger of chasing hot stocks. You buy at the moment when everyone else already believes in the good news. Instead, you'll learn to buy when the story hasn't yet dazzled the crowd, when the price understates the value. Imagine walking through a farmer's market where the apples on one stall gleam red and perfect, and on the next table, you spot apples with faint blemishes and sunspots. The glossy apples command top dollar, and everyone flocks to them. Meanwhile, the spotted apples sit unsold, even though they taste just as sweet. You step in, scoop up a bushel at half price, and carry them home. That's what buying undervalued stocks feels like. In your investing journey, intrinsic value is the tastiness of the apple, the true underlying worth of the company, its earnings power, its cash flow, its competitive edge, its management integrity. The price, by contrast, is what the crowd is willing to pay in the moment. When price dives below intrinsic value, you find a margin of safety, a cushion that protects you when unforeseen storms hit. You don't need to be a Nobel laureate to estimate value. You start with simple arithmetic. Look at a company's revenue, subtract its expenses, factor in taxes, and arrive at free cash flow. Think about how that cash might grow over time, compounded by smart reinvestment or returned through dividends. That projection becomes your mental map of what the business is worth today and years from now. Then you glance at its current market price. If the price sits comfortably below your conservative value estimate, that's your signal to act. Of course, you wrestle with uncertainty. No model perfectly predicts the future. That's why conservative assumptions become your ally. If you assume growth of 5% when the company has historically grown at 10%, you cushion against disappointment. If you apply a higher discount rate to account for economic shocks, you temper your optimism. Each conservative tweak broadens your safety margin, ensuring the worst-case outcome still keeps you out of harm's way. You recall the dot-com boom, where companies with no earnings soared at hundreds of times revenue. Investors believed that this time was different, that the internet would reshape every industry instantly. The crowd piled in, prices raced skyward, and those who ignored fundamentals found themselves holding vapor when the music stopped. Meanwhile, patient investors scoured the rubble for undervalued gems, companies with solid profits, trading like they were zombies. When fear overtook greed, those who stuck to value principles snapped up bargains and reaped outsized gains in the recovery. Now picture a recent scenario. A household name retailer faces headwinds as e-commerce grows. The pundits declare its demise, and its stock tumbles. You dig into the balance sheet. Inventory is lean, debt manageable, and the brand still resonates. You run your numbers and find that even if profits dip 20% next year, the share price still leaves room for upside when the industry normalizes. You invest, not because you're certain of a rebound, but because the price understates the business's resilient cash flows. Over time, the market recognizes that mistake, and your position gains momentum. Value investing doesn't require flashy analytics or privileged insights. You treat each company like a small business you might run yourself. You ask, would I lend money to this enterprise at this price? Could I buy the whole thing and still sleep soundly at night if sales stall? If the answers make you uneasy, you pass and move on. If you find comfort in the numbers, that's when you pull the trigger. Embracing undervaluation also trains you in discipline. When a stock you own doubles, you pause. Does the price still support the value estimate? If not, you trim your position or lock in gains. When a sector soars, you remind yourself that narratives shift faster than fundamentals. Enthusiasm can drive prices into bubble territory. By contrast, undervalued stocks seldom generate excitement. You must learn to swim against the current, to look for opportunities precisely where others feel discomfort. One of the great ironies you'll confront is that true value often lurks in forgotten corners. Small cap companies with niche products, cyclical firms beaten down by commodity swings, or even well-known brands mispriced due to temporary setbacks, all can offer attractive entry points. Your task is to separate temporary issues from permanent damage. A company missing earnings targets because of a one-time charge, that's often a buying signal. A company with structural obsolescence that you must avoid, regardless of the low price. You'll build a checklist. Does the company generate consistent free cash flow? Is its debt load manageable? Does it hold any durable competitive advantage, brand loyalty, patents, proprietary technology? How credible is the management team? Does the valuation reflect historic low multiples, like 5 times earnings when the broader market trades at 20? When enough boxes check out and the downside is limited, you gain the conviction to invest confidently. Over years, this approach cultivates a mindset shift. You no longer feel compelled to buy the biggest movers or hottest sectors. You see potential where others see risk, and you view panic sell-offs as invitations, not warnings. You understand that good businesses can endure storms and emerge stronger, but only if you enter at the right price. That discipline extends beyond individual stocks. When entire markets become euphoric, when broad indices trade at sky-high multiples, you reduce exposure, allocate to cash, or shift into more defensive corners. When markets collapse, you redeploy cash into undervalued assets, knowing that the bargains you missed earlier will reappear. In this way, undervaluation becomes your compass. It steers you toward opportunities and away from traps. You avoid paying emotional premiums that evaporate as soon as sentiment shifts. You build a portfolio that survives downturns because each holding carries a buffer. You accumulate wealth not in heroic leaps, but steady steps. By mastering the gap between price and value, you transform investing from speculation into a true wealth-building discipline. You learn to see past the chaos of headlines and hype, focusing instead on the quiet arithmetic of cash flows and conservative projections. You discover that success often lies in humility, accepting that the market can be irrational, and waiting patiently for reality to catch up with opportunity. As you close this section and prepare to move forward, and remember, true value isn't what others say it is, but what the business can generate over time. Seek the mispriced opportunities hiding in plain sight. Buy them with conviction. Let the margin of safety protect you. Then watch, with calm confidence, as the market eventually recognizes what you already know. You've seen how value lurks in the shadows when everyone's eyes are fixed on the bright lights of hype. Now you're ready to discover why your mindset matters more than any spreadsheet or fancy algorithm. You're not a passive number cruncher. You're an active thinker, a contrarian at heart. And you'll learn how that edge outperforms rigid formulas every time. When you sit down at your desk, a dozen browser tabs open to financial models and screening tools, it's tempting to believe that the right combination of ratios, PCE, PEG, or OIEC, will spit out your next multibagger. You plug in historic earnings growth, forecast future cash flows, apply a discount rate, and voila, a tight evaluation pops up. Then you compare it to the market price, and the software paints your verdict in green or red. It feels scientific, objective, like you're strapping on a jetpack to zip ahead in the race. But here's the catch. Those spreadsheets reflect past data and consensus expectations, not the unpredictable twists of human behavior and market psychology that actually drive prices. Imagine a chef following a recipe to the letter, precise measurements down to a grain of salt, while the truly great cooks then taste as they go, adjusting seasonings based on intuition and subtle signals. You want to be that intuitive cook in investing. Yes, you need the recipe, financial metrics, balance sheets, discounts. But you also need the confidence to tweak ingredients, to add a pinch more skepticism, to stir in a dash of contrarian insight when everyone else follows the same printed instructions. Contrarian thinking starts with questioning the consensus. When the crowd says, buy, you ask, why? When algorithms highlight the top momentum stocks, you probe whether momentum has already peaked. When backtests show a factor has worked over the last decade, you wonder whether that period was an outlier. By interrogating the assumptions baked into any model, you identify where human judgment outshines pure computation. Take the 2008 financial crisis. Quant funds loaded up on collateralized debt obligations. Models saying risk was minimal because housing never goes down nationwide. Those black box formulas calculated low volatility and high diversification. Meanwhile, a few investors, people who read the fine print of mortgage-backed bond covenants, who understood the incentives of loan originators, saw the cracks forming. They didn't trust the soothing statistics. They thought, if everyone is complacent, maybe that complacency is the biggest risk of all. Those contrarians who shorted subprime securities made fortunes, not because their spreadsheets were more complex, but because they thought differently about the inputs. You can adopt that mindset. Start by seeing any model as a tool, not a gospel. Every output, every ratio, every projected growth rate is only as reliable as its inputs and assumptions. You develop a habit of challenging them. Are the historical data points representative? If a company's past growth came from one-time events, you don't assume it repeats. Are the forecasted drivers realistic? If you model a 20% annual sales increase, ask yourself what new customers, new markets, or new products make that plausible. Do scenarios account for black swans? If your worst-case scenario still assumes a functioning credit market, you may be ignoring systemic risk. By poking holes in your own models, you force yourself to think at a second level, what Buffett calls thinking beyond the obvious. While your peers nod along with the spreadsheet's green light, you've already identified the hidden caveats. Contrarian thinking also thrives on pattern recognition beyond standardized data. You notice that When CEO interviews turn eerily polished, hiding behind slick communications, insiders may be managing expectations. When a management team criticizes regulations more than they improve operations, you question whether they're lobbying in anticipation of a windfall, not building sustainable growth. When insiders sell a flurry of shares after touting a turnaround, you consider it a red flag, even if models still rate the stock a buy. You develop a radar for nuance, a CEO's carefully chosen words, a CFO's footnote caveat, an auditor's terse going concern warning buried at the bottom of the annual report. These aren't metrics you can code into a screener. They're insights you glean by being present in the narrative, listening to conference calls, reading footnotes, watching executive body language when they describe the future. That presence of mind extends to market sentiment. Pop a meme-driven stock that's soared 500% in a week. Algorithms will flag it for momentum. But contrarians will ask, why now? Who's left to buy at these prices? You'll recognize that fear of missing out can drive prices far beyond fundamental support, and you'll simply step back. You won't short a momentum craze alone. You understand timing those reversals is notoriously tricky, but you won't join the frenzy, and you'll keep your powder dry for truly compelling bargains. Your contrarian edge also comes from emotional discipline. Algorithms have no feelings, but they can't manage human bias either. You will. When you sense euphoria or panic, you pause, take a deep breath, and remind yourself, the market is a voting machine in the short term, a weighing machine over the long term. If short-term sentiment drives prices into extremes, you resist the herd impulse. You avoid buying at the peak or selling at the nadir. You cultivate a mindset that welcomes volatility as an ally, not an enemy, because you view price swings as opportunities to buy more at discounts or trim excess positions for redeployment later. Of course, you don't become a contrarian for its own sake. You don't fight the crowd just to be contrary. You fight the crowd when it makes mistakes. You adopt a mindset that blends respectful skepticism with opportunistic courage. When others panic, you calmly reassess values. When others exuberantly chase trends, you patiently scan for mispricings. You've built the mental framework that says, I won't assume the consensus is wise. I'll seek reasons it might be wrong. That framework also supports your learning agility. Every time a new anomaly arises, you seek to understand its drivers. Did COVID-era technology adoption accelerate digital transformation permanently? Or did it simply pull forward demand? You analyze which businesses emerge stronger and which face structural headwinds. You refine your skepticism and adapt your mental models accordingly. Your contrarian mindset becomes a habit, reinforced each time you resist the siren call of automated buy signals and instead listen to the quieter voice of your own analysis. You track your outcomes, not just wins and losses, but the thought processes that led you there. You celebrate the times when your skepticism saved you from a bubble, and you introspect on occasions when contrarian bets backfired, asking, was I too early? Did I misread a structural shift? How can I improve my mental model? Over time, this active and mental approach compounds like returns in a well-managed portfolio. You become adept at spotting where formulas break down, where crowd psychology skews prices, and where real opportunity hides behind algorithmic noise. While many investors chase the next flashy quant strategy, you cultivate a quieter but more enduring edge, the ability to think differently and to act when others hesitate. In adopting this contrarian mindset, You turn investing into an art as much as a science. You respect the science of financial modeling, but you temper it with the art of human understanding, behavioral insights, strategic nuance, and emotional resilience. You no longer feel powerless to competing machines and vast pools of data. Instead, you stand on the strengths of your own intellect and judgment. So as you move forward, remember, spreadsheets and algorithms can illuminate patterns, but they can't replace the active mind that questions fundamentals, detects sentiment shifts, and makes bold decisions when everyone else follows the script. Your contrarian mindset is your greatest tool, more powerful than any model, more adaptable than any black box system. Embrace it, sharpen it, and watch it guide you toward opportunities the crowd overlooks and pitfalls it stumbles into. You sit in your favorite chair late at night, charts glowing on the screen, caffeine still swirling in your veins, and you wonder, is this my genius at work or just sheer luck? You've crunched the numbers, crafted the perfect thesis. Yet in the market's grand theater, randomness often steals the show. In this section, you'll confront the surprising role of luck in investing and master the art of tilting the odds in your favor. So skill emerges ahead of chance. Imagine a poker table where you play perfectly, reading tells, calculating pot odds with laser focus. And still, the flop can bring you a straight or a river can crack you on a flush that wasn't there an hour ago. Investing follows the same script. You can perform every analysis flawlessly, but random events, geopolitical shocks, sudden CEO scandals, viral social media posts can upend even the soundest positions. You learn that success isn't about eliminating randomness, that's impossible, but about managing its impact so that skill, not mere luck, dictates your outcomes over time. You remember the tale of Nassim Taleb stumbling onto trading floors in the 90s. He observed traders celebrating massive gains after years of mediocre performance, only to discover they'd simply ridden a lucky streak of favorable volatility. When he read his own trades in print, he realized his profitable months weren't proof of brilliance. They were circumstantial. Taleb taught you that should does not equal will. Just because a strategy appears so rational that it should work doesn't guarantee it will. Embracing this humility becomes your first defense against blind overconfidence. Your journey into randomness begins with dissecting outcomes. When a stock you recommended doubles in months, ask yourself, was the company's breakthrough so unexpected that you captured rare alpha? Or was it simply part of a broader market surge? Did you isolate specific catalysts, like a revolutionary product launch? Or did you ride a wave of sector euphoria that lifted every boost? By distinguishing skill-driven wins from luck-driven windfalls, you refine your decision framework. You keep the former and treat the latter as a welcomed bonus, not proof of infallibility. Consider the story of two fund managers. Manager A posts a 15% annual return for 3 years and receives lavish praise. Manager B returns a modest 5%, but does so with half the volatility. When the fourth year brings a 20% market crash, Manager A's fund plummets 40%, while Manager B loses 12%. Manager A's early success was partially luck. He caught the market at a favorable moment, while Manager B's disciplined, lower-risk approach was skill, protecting capital when the storm hit. Over a decade, Manager B's steady compounding outperforms the volatile roller coaster of Manager A, illustrating how managing randomness leads to better long-term results. You adopt probabilistic thinking. For every idea, you sketch a probability distribution of outcomes. Worst case, base case, best case. You allocate capital based not only on your conviction in the base case, but on how tolerable the worst case is. If a position carries an 80% chance of modest gains, but a 20% chance of catastrophic losses, you size it small or avoid it altogether. Conversely, if a trade offers limited downside, but significant upside, even if the base case return is modest, you overweight it. This tilts the odds toward a portfolio that thrives over many trials. Embracing randomness also means cultivating the right temperament. You learn to view drawdowns not as personal failures, but as inevitable blips on a probabilistic journey. When your positions fall 15% in a month, you don't panic. You assess whether your original thesis remains valid. If nothing fundamental changed, you may even add to your position, capitalizing on mispricing born of temporary fear. Other investors, blinded by loss aversion, sell at the trough and lock in regret. You choose to see that downturns offer a chance to deploy cash at attractive levels. Another tilt of the odds. You sharpen your edge by hunting situations where randomness works in your favor. For example, volatility crushes premium on option strategies. Instead of buying expensive call options on a hot biotech stock, you sell out of the money puts on established companies with healthy balance sheets. You collect premiums that decay over time, and if you get assigned, you acquire a solid business at a discount. You bank on time decay and the fact that markets tend to overestimate downside risk in the short term. That's not stupidity. It's a systematic tilt toward probabilities that reward you. In another realm, you embrace diversification not as a dull compromise, but as a shield against unknown unknowns. You spread risk across uncorrelated assets, stocks, bonds, real estate, even small allocations to alternative strategies, so that random shocks in one corner don't derail your entire plan. When tech stocks stumble, your real estate holdings or value-oriented positions may soften the blow. You resist the temptation to concentrate in your best ideas, knowing that overconfidence and randomness can combine to produce devastating outcomes. A powerful tool you wield is the long-time horizon. Time itself averages out randomness. If you plant an apple seed and harvest after 1 week, chance will dominate. Maybe it rains, maybe it doesn't. But if you nurture it over years, the tree's health, soil quality, and good care determine the fruit's yield far more than random weather blips. Similarly, compounding over decades lets your skillful selection and disciplined approach outweigh short-term noise. Random spikes matter less. The underlying business performance shines through. You also embrace anti-fragility, a concept Taleb champions. You structure your portfolio so that volatility and shocks actually benefit you. For instance, having more cash on the sidelines during bull markets allows you to pounce when fear grips the market. You position in out-of-favor cyclicals at the depths of their downturns, knowing that recovery cycles eventually reward patience. You design your strategy not just to resist randomness, but to profit from it. Your habit of recording every trade, win or loss, becomes a critical feedback loop. You note entry price, thesis, risk parameters, and outcome. When a trade goes your way, you ask whether it was primarily luck or skill, tagging it accordingly. Over time, you build a personal data set of insights. Which strategies performed well? Which emotions tripped you up? Which biases skewed your judgment? This self-reflection refines your process and gradually amplifies your skill edge over luck. Importantly, you avoid overreacting to outliers. When a high-profile crash wipes out iconic names, you don't abandon your entire process. You analyze failures dispassionately. Was the company's collapse due to fundamental decay you missed? Or was it an extreme case no model could predict, i.e. you adjust where needed? But you don't discard your framework because of a single extreme event. You recognize that outliers exist by definition and must be managed, not smeared across every decision. Ultimately, you accept that you'll never fully control randomness. No clever system can eradicate luck's role, but you can structure your approach so that over many years, the curve of your results is tilted toward skill. You seek situations with positive skew, modest losses but meaningful gains, and you build resilience through C's management, diversification, and time. You refrain from ego-driven overconfidence, reminding yourself that the market's randomness doesn't discriminate between novices and wizards. As you internalize these lessons, your relationship with risk and reward transforms. You no longer see luck as a villain to be conquered, but as a natural force to be respected and managed. You leverage randomness by leaning into strategies that favor asymmetry, by sizing positions so that occasional wins vastly outpace numerous small losses. You gain the freedom to tune out daily noise, knowing your process has accounted for the market's capricious nature. By cultivating probabilistic thinking, emotional discipline, and a portfolio built to benefit from volatility, you transform randomness from a threat into an ally. Luck may still strike, sometimes for, sometimes against you, but you ensure that skillful preparation, humble recognition of uncertainty, and structured resilience govern your long-term success. You build a strategy that dances with randomness rather than fights it, tilting the odds so that, over time, your wins reflect your skill far more than blind chance. You're scrolling through headlines as you sip your morning coffee, eyes darting from GDP forecasts to interest rate predictions, and you wonder, should I pivot my portfolio based on this macro chatter? You feel the tug of authority. After all, if economists predict a slowdown, maybe you need to sell. But here's the truth. Most macro forecasts are little more than educated guesses, and acting on them can do more harm than good. In this section, you'll learn why tuning out the noise often beats trying to outguess every twist in the broader economy. You start with a quick thought experiment. Imagine you're driving on a winding mountain road, radio blasting weather alerts predicting a storm. Do you slam on the brakes every time a new alert pops up? No. You focus on the road ahead. Adjust speed when you actually see storm clouds, and trust your immediate observation more than distant forecasts. Investing works the same way. You monitor the fundamentals of the companies you own, not every economy-wide prediction that flashes by. One of the first lessons you absorb comes from the legendary economist John Kenneth Galbraith. He quipped that there are two types of forecasters: those who don't know and those who don't know they don't know. You smile at that because it resonates. Every time you read a sweeping forecast of interest rates or unemployment, you sense how little certainty exists. Yet many investors treat these broad predictions as gospel. Shifting allocations on every new data point, you choose not to. You recall the Wall Street Journal's semi-annual economist poll. For decades, it asks 30 or 40 experts to predict growth, inflation, unemployment, oil prices, and more, most years. The consensus forecast comes true simply because everyone expected it and markets priced it in well before the announcement. When GDP turns out to be 2%, the forecasters breathe a sigh of relief. We got it right. But no one profits, because prices already reflect that outcome. You realize that forecasting the consensus isn't a money-making edge. It's a mirage. That realization steers your approach. You still form macro views, of course you do, because businesses operate within an economy. But you don't treat those views as prescriptive triggers. Instead, you ask, how would this macro trend affect my specific holdings? If you own a consumer staples company with strong brand loyalty, a mild recession might dent sales temporarily, but earnings will likely rebound. You adjust your stress testing scenarios, but you don't overhaul your core thesis on every Fed statement. You learn to distinguish between extrapolative forecasts and radical ones. Extrapolative forecasts simply predict more of the same. Growth will be 2% because it's averaged around 2% for the past few years. Those forecasts work often because the future usually resembles the recent past, but they don't move markets. Radical forecasts, growth will plunge to 3% next year, are the ones that could drive big market moves. But they're also the hardest to get right. You recognize that you gain nothing by betting on consensus extrapolations. You seek insights that differ meaningfully from the average view, but you only act on them when you hold high conviction supported by strong evidence. You remember an episode from your early investing days. A well-known strategist boldly declared that interest rates would hit 7% by year-end. You nearly reallocated your bonds to short duration, worrying about price declines. But something in your gut told you this forecast ignored the Fed's dual mandate constraints and global demand for yield. When rates instead hovered around 2.5%, you dodged a needless portfolio shuffle. That experience taught you to treat macro calls as worthy of consideration, but not as mandates. Your skepticism deepens when you study crisis forecasting. Before the 2008 meltdown, some strategists warned of a housing collapse, but their voices were drowned by glowing reports on property values. After the crisis, everyone claims foresight. You've seen postmortems rewrite history to make missed warnings sound mainstream. You decide that rather than chasing gloomy forecasts, you'll watch indicators that matter: credit spreads, loan-to-value ratios, and bank lending standards. Those microeconomic signals, tied directly to individual sectors and companies, provide earlier warning signs than broad economic pronouncements. You refine your process by creating two sets of mental filters. First, you maintain a macro framework that monitors 6 to 10 high-level indicators: unemployment, inflation, Fed policy communication, credit conditions, manufacturing PMIs, and consumer confidence. Or you update these quarterly and not daily, and you treat them as background color, not front-page news. Second, you build company-level stress tests. For each stock you own, you ask, if GDP shrinks 2%, what happens to margins? How much cash buffer is available? Can management cut costs quickly without harming the brand? These tests guide position sizing and conviction, but don't lead to frantic position changes at every data release. You also learn to respect data lag. Many economic indicators report with a delay: 2 weeks for PMI, a month for employment data, a quarter for GDP revisions. By the time you read the headline, the market has already adjusted. You resist the urge to chase lagging signals. Instead, you focus on real-time inputs, company sales trends, inventory levels, supplier feedback, and anecdotal color for management calls. You discover that these microsignals often precede the macro releases and equip you to anticipate true shifts before they hit the headlines. An important epiphany arrives when you study commodity cycles. You follow an economist's forecast that oil prices will rise to $100 based on OPEC production cuts. Almost everyone piles into energy stocks, yet you note that U.S. shale producers can ramp output quickly, capping price spikes. You adjust your thesis rather than broad exposure to energy. You seek mid-cap service companies with pricing power and lower break-evens when oil prices instead oscillate around $50, $60. Your selective exposure outperforms simple long oil plays. That discipline, combining macro awareness with industry nuance, proves far more effective than flat macro bets. You find further reinforcement in behavioral biases. The availability bias tempts you to overweight recent dramatic events, bank failures, inflation scares, trade wars. But the cognitive ease of recalling those headlines tempts you into action, even if fundamentals haven't shifted. To counter this, you adopt a quiet check ritual. Whenever you feel an itch to trade based on current headlines, you pause, journal the exact trigger, then wait 48 hours. If the urge still persists, you revisit your core thesis and data. Most of the time, the impulse fades, and you avoid needless churn and transaction costs. Your approach evolves into a balanced dance. You tune into macro signals enough to avoid being blindsided by major regime shifts. But you don't let every data release derail your core positions. You set macro thresholds, say unemployment above 8% or inflation below 0, where you trigger portfolio reviews. But these thresholds are wide margins, not tight stop-loss triggers. You respect the market's macro undercurrents without reacting to every ripple. Ultimately, you discover that macro forecasting is akin to predicting the weather months in advance. Possible, but rarely precise enough to guide day-to-day decisions. You shift your focus to what you can analyze in depth: the health of individual businesses, their competitive moats, and their cash flow resilience. You accept that the economy's broad tides influence all boats, but you choose to navigate by your own compass, company fundamentals, rather than by every shifting wind. By mastering this selective attention, you transform your portfolio into a vessel that sails smoothly through both storms and calm seas. You respond to genuine macro inflection points without being buffeted by every headline. You remain invested in businesses you understand, adjusting only when fundamental shifts warrant change. In doing so, you sidestep the common trap of overreacting to macro noise and instead lean into the clarity of company-specific insight. You step onto the market court like an amateur tennis player, racket in hand, heart racing, and you realize that hitting winners isn't everything. Sometimes the best way to win is to simply not hit unforced errors. Investing follows the same logic. When you can't guarantee a home run, your priority is avoiding the big mistakes that wipe out years of hard-earned gains. In this section, you'll master defensive strategies that protect your capital and let compounding work its magic, so you stay in the game no matter what curveballs come your way. Imagine you're in a casual tennis match. Your opponent is formidable, but you're not a Grand Slam champion. If you try aggressive winners on every serve, you'll miss more than you land. Instead, you play a loser's game. You return every shot with calm consistency, making your opponent earn every point. Over time, fatigue sets in, unforced errors creep into their game, and you edge out the victory. In investing, that means constructing a portfolio that minimizes downside risk, even if it means muted upside in the short term. Because surviving to play another day is the ultimate victory. You begin by embracing margin of safety. Before you commit $1 to any stock, you ask, what's the worst case scenario? Can I tolerate a 30% decline and still sleep at night? If the answer is no, you dial back your position size. You never load up on a single idea just because it boasts flashy upside potential. You size convictions based on both upside reward and downside tolerance. This simple rule prevents you from gut-wrenching losses when the market turns. Next, you diversify thoughtfully. You don't blindly buy dozens of random stocks. You blend exposure across uncorrelated sectors and asset classes. You allocate not only to large caps and small caps, but also to bonds, real estate, and perhaps a small allocation to alternatives like managed futures or commodities. When technology falters, defensive healthcare or stable consumer staples can soften the blow. Your aim isn't to own every stock under the sun. It's to own a mix that cushions volatility. So, any one misstep, it won't derail your entire journey. You also set clear stop-loss guidelines, but you don't tighten them to a hair trigger. Instead of a 5% cut loss that triggers frequent, emotion-driven selling, you set wider bands, perhaps 15% for core holdings and 25% for speculative positions. Why? You know that daily noise can trigger harmless dips, and you don't want shallow corrections to force you out of positions that still merit your conviction. But if a core stock falls beyond 15% because fundamentals cracked, say a sudden debt default or fraud revelation, you exit promptly, preserving capital for more attractive opportunities. Hedging becomes another layer of defense. You learn to use options not as main bets, but as insurance. When you hold a concentrated position in a high beta stock, you might buy a modest number of put options that cap potential losses without draining your cash flow. You're not speculating on volatility. You're paying a premium to protect against extreme adverse moves. Over time, the modest cost of these hedges is a small price for preserving your core capital. Your defensive toolkit also includes quality tilts. You bias your allocations toward companies with strong balance sheets, those with low debt-to-equity ratios, ample cash, and robust free cash flow generation. These businesses weather downturns better because they can sustain operations without relying on external financing. When credit markets freeze, these high-quality names stand firm, and you emerge from recessions in a relative position of strength. You reinforce defense with valuation discipline, even in strong bull markets. You resist the temptation to chase momentum at any price. If a stock's PE ratio stretches to 50x earnings, you ask, does this company's growth justify that level? What happens if growth slows to half my forecast? If pricing leaves no margin for error, you wait on the sidelines. Often, you redeploy capital into companies trading at more reasonable multiples, where a small misstep by management or a temporary earnings miss won't vaporize your gains. Risk assessment becomes routine. You build checklists that include both quantitative metrics, debt ratios, payout ratios, free cash flow yield, and qualitative factors like management integrity, competitive moats, and regulatory risks. Before adding to any position, you revisit that checklist and ask, has anything changed? Are new risks emerging? If management issues arise, if a competitor launches a disruptive product, or if regulation shifts, you reevaluate your thesis. The moment the balance tilts toward increased risk, you either reduce or exit, preserving your capital for safer opportunities. You also practice scenario analysis. For each core holding, you sketch at least 3 scenarios: base case, pessimistic case, and optimistic case. You then assign probabilities, say 60% base, 25% pessimistic, 15% optimistic, and calculate expected value. If the weighted outcome still leans positive, you proceed. If the pessimistic scenario threatens your survival, you either hedge or avoid the position. This methodical approach detaches you from emotional overconfidence and anchors decisions in sober risk-reward assessments. Stop losses and scenario analysis work in tandem. When a position approaches your pessimistic threshold, you don't panic sell. You revisit your probability weights. If fresh data reduces the odds of the base case and increases downside likelihood, you cut, size, or hedge. If the core thesis remains intact, say a merger delay rather than cancellation, you may hold firm, trusting your original assumptions. This flexibility prevents knee-jerk reactions while ensuring you stay alert to evolving risks. Another key defensive edge is portfolio review cadence. You schedule quarterly Risk Fridays, where you zoom out and assess macro factors, portfolio concentration, and correlation shifts. These you ask, is my portfolio still aligned with my risk tolerance? Are correlations rising because everything is moving in lockstep? Should I rebalance to trim winners and fund laggards that offer better value? These regimented reviews prevent inertia from breeding complacency, and they keep your defense framework alive, not buried under endless market noise. You also guard against liquidity traps. You avoid positions where exiting requires painful discounts, thinly traded microcaps, or niche assets with few buyers. You favor securities in liquid markets, so when a stress event strikes, you can adjust swiftly rather than waiting days or weeks for an exit. Liquidity is a silent risk factor. You respect it as much as any balance sheet ratio. Above all, you cultivate emotional discipline. When headlines scream crash, you resist the fight-or-flight impulse. You remind yourself of your margin of safety, the quality of your holdings, and your hedges in place. You resist the siren calls of panic, selling that lock in losses. Meanwhile, when market's euphoria reaches mania levels, you firm your resolve to trim positions or rotate into more defensive corners. You let fear and greed play out in other portfolios. You stick to your plan. By combining margin of safety, diversification, position sizing, valuation discipline, hedging, scenario analysis, and emotional control, you forge a defensive fortress around your capital. You transform investing from a high-wire act into a measured journey, where surviving every market storm is your greatest victory. Over time, this defensive mindset doesn't just protect you, it positions you to capitalize on opportunities that arise when others concede to fear. You stay in the game, ride out volatility, and let steady compounding build your wealth. One resilient step at a time. You're scanning the universe of boring securities, corporate bonds that no one talks about, small cap stocks no one follows, dividend yields that look pedestrian, and you wonder, could these unloved corners hold the key to outsized returns? In this section, you'll discover how embracing high-yield opportunities, whether in bonds or underappreciated equities, tilts the odds toward the upside. turning low expectations into your greatest advantage. Imagine you walk into an auction and find a dusty painting that everyone else ignores. The sign says, "Reserve $100," yet the bidders pass it by because it lacks a flashy provenance. How? You raise your paddle, win it for $80, and later learn it's an undiscovered masterpiece. That's the essence of high-yield investing. You buy assets trading at depressed levels, surfacing from neglect rather than hype. And you position for the gains that come when the broader market finally notices their true worth. Your first real encounter with this dynamic comes from a meeting with Michael Milken in late 1978. You sit across a mahogany table in a New York conference room, and Milken, lean and energetic, lays out his thesis: high-yield bonds, then called junk, offer asymmetric potential. He explains that AA bonds, now rated by Moody's as near perfect, can only go one way, down, if anything. Those top-rated companies have little room to improve, and any hiccup, high economic slowdown, rising costs, pushes prices lower. By contrast, single B bonds trade at deep discounts because expectations are low. If those firms survive, credit upgrades or takeovers can drive bond prices sharply higher. You lean in, intrigued. So the bad apples have more room for positive surprises. Milken nods. You realize you found a contrarian gold mine. That meeting sparks your first high-yield allocation. You commit a modest sum to a basket of single B bonds issued by regional railroads and industrial firms facing temporary headwinds. A year later, several companies secure refinancing and improve operations. Moody's upgrades their ratings, and you watch yields compress from 12% to 8%. Your total return, including coupons, soars above 25%, while investment-grade bonds return barely 6%. You learn that low expectations can fuel outsized returns when the market corrects its oversight. You carry this insight into equity markets. You identify small-cap companies whose bonds trade at junk yields, signals of distress that have nothing to do with long-term potential. You dig deeper. Management quality is solid, cash flow is sufficient, and the business operates in niche markets with loyal customers. The stock trades at a 30% discount to your conservative valuation due to widespread fear. You buy, confident that if debt challenges ease, the equity revaluation will follow. When a friendly acquirer swoops in, you collect a 3x return. Again, high yield and high discount become the fertilizer for exceptional growth. Over time, you refine your approach into a step-by-step playbook. Hunger 1. Screen for elevated yields or discounts. You monitor both bond and equity markets for yields or valuation, multiples significantly above historical norms. In equities, you look for low P/E ratios, depressed free cash flow yields, or dividend yields above 5 to 6%. In bonds, you scan for spreads over treasuries that exceed 500 basis points. 2. Conduct rigorous credit and fundamental due diligence. High yields signal elevated risk, not guaranteed returns. You dive into financial statements, debt maturity profiles, examine covenant protections, and gauge liquidity. For equities, you evaluate management track records, competitive positioning, and regulatory exposures. You ask, can this company survive a mild recession? Does it have the liquidity to service debt? If you can confidently answer yes, you're ready for step 3. 3. Establish a margin of safety. You estimate the intrinsic value, net asset values, discounted cash flows, liquidation values, and ensure the market price offers at least a 20-30% cushion. That safety net absorbs unforeseen shocks, whether a cost overrun or temporary sales slump. Here are 4. Position size based on risk tolerance. You resist the temptation to overweight these opportunities, given their risk profile. You cap any single high-yield investment at a modest percentage of your portfolio, often 2 to 3%. This prevents idiosyncratic drags from crushing your overall performance. 5. Monitor catalysts. You track refinancing plans, pending regulatory approvals, turnaround progress, or potential M&A interest. These catalysts drive yield compression and valuation convergence. When milestones arrive, you assess whether to take profits, hold for further upside, or adjust hedges. 6. Manage maturity and liquidity. In the bond market, you prefer maturities within 3-7 years, balancing yield pickup against refinancing risk. You also favor bonds with active trading, so exiting is straightforward if your thesis falters. For equities, you stick to stocks with sufficient daily volume to avoid being trapped in a downturn. As you implement this playbook, you witness powerful results. You recall the late 1990s telecom wreck, when debt yields shot above 20% for major carriers. You quietly purchase bonds and preferred stock, knowing those companies possess indispensable infrastructure. When consolidation restores profitability, yields collapse to single digits and principal values surge. Your annualized returns during that cycle exceed 30%, while the broad market languishes. The same pattern emerges in the 2008-09 financial crisis. Financial institutions and cyclical firms trade at distressed levels far below book value. You sift through bank balance sheets, find franchises with manageable loan loss reserves, and scoop up subordinated debt and equity at pennies on the dollar. As the credit cycle turns, government backstops and capital raises stabilize the sector, and you realize double-digit returns on positions purchased at fraction of par levels. Yet you remain vigilant. High yield is a double-edged sword. You learn from painful lessons too. You remember a steel manufacturer you bought when its bonds yielded 15%, believing a cyclical rebound was imminent. But structural shifts, electric arc furnace competition, and rising labor costs undermined long-term viability. The company reorganized under bankruptcy protection, and you lost much of your capital. That experience hardens your discipline. Cyclical woes must be temporary, not permanent, secular declines. You add an extra filter for industry dynamics, ensuring that catalysts align with a sustainable business turnaround. You also expand your toolkit with structured credit hedges. You sell credit default swaps on sectors your high-yield positions don't cover, effectively hedging idiosyncratic tail risk. The small cost of protection pays dividends when unexpected defaults emerge. You avoid the trap of overexposure, preserving core capital for your best ideas. Throughout your journey, you maintain a contrarian mindset. You lean into sectors when fear peaks, and you pull back when optimism blindsides everyone. You see value where others see despair, in companies grappling with temporary headwinds, not existential threats. You let the crowd's pessimism become your opportunity. Importantly, you integrate high-yield strategies seamlessly with your broader philosophy. You don't treat them as exotic bets. You view them as logical extensions of buying undervalued assets with strong margins of safety. You apply the same principles, rigorous analysis, conservative assumptions, position sizing, and catalysts, to both high-yield bonds and overlooked equities. Over years, this disciplined high-yield approach compounds. You harvest double-digit yields, reinvest coupons, and rotate capital into the next set of dislocations. In bull markets, You cap gains and scan for fresh opportunities. In bear markets, you deepen positions at attractive levels. The result is a portfolio that outperforms in both up markets and downturns, driven by consistently profitable niche opportunities. By embracing high-yield opportunities, you transform low expectations into a powerful tailwind. You learn that the greatest mispricings occur where pessimism reigns, and that patiently applying your framework reaps outsized rewards. You master the art of buying when others flee, and you let compounding of elevated yields build real wealth over time. You settle into your routine, coffee in hand, journal open, mind buzzing with competing insights, and you realize that to navigate the market's complexities, you need more than rules. You need a personal investing creed. A philosophy is not a static rule book, but a living contract with yourself, an anchor that guides your decisions when emotions roar and markets shift. In this section, you'll craft a philosophy that blends the wisdom of the greats with your own hard-learned lessons, transforming scattered ideas into a coherent, actionable creed. You begin by collecting the touchstones that have shaped you. From Taleb, you borrow the humility to acknowledge randomness and the conviction to seek anti-fragile strategies. From Galbraith, you glean skepticism toward forecasting the consensus. From Ellis, you learn the power of defensive positioning and embracing the loser's game. From Milken, you take the insight that low expectations create fertile ground for upside. And from your own experiences, the wins, the losses, you derive practical rules about position sizing, margin of safety, and emotional control. Each lesson feels like a puzzle piece, waiting to fit into a broader picture. With these insights in hand, you open your journal and write the first draft of your creed. You start with a powerful opening statement. I believe that investing is less about predicting the future and more about positioning for a range of possible outcomes. That sentence becomes the North Star for every position you take. It reminds you that forecasting certainty is an illusion and that your edge lies in managing uncertainty. Next, you flesh out your 6 core tenets, principles that will guide every trade. 1. Control risk above all you pledge to prioritize capital preservation over chasing outsized returns. You commit to sizing positions so that any single loss never jeopardizes your overall portfolio. Embrace value over hype. You vow to buy assets trading below your conservative estimate of intrinsic value, resisting the allure of popular narratives that drive prices to unsustainable heights. 3. Think contrarian with conviction. You promise to question consensus assumptions, probing whether prevailing market sentiments already reflect the true outlook, and only act when you see real mispricing. 4. Lean into asymmetry. You resolve to seek situations where downside is limited but upside is significant, whether through high-yield bonds, distressed equities, or option strategies that benefit from time decay. 5. Accept randomness. Tilt odds. You commit to probabilistic thinking, sketching worst as base and best cases for each idea, sizing based on downside tolerance, and hedging where necessary to skew outcomes toward skill. 6. Evolve continuously. You embrace the notion that no philosophy is ever done. You'll review and refine your creed quarterly, incorporating new lessons from market cycles and personal logs. As you write, you anchor each tenet with a memorable phrase. Under risk control, you inscribe, "Survival is victory. For value, you note, buy when optimism wanes. Contrarian thinking earns, question the chorus. Asymmetry is distilled to limited downside, unlimited upside. Randomness, respect chance, manage outcomes. Evolution, stay curious, stay humble. These sound bites serve as mental triggers when markets roar, quick reminders that slip easily into your decision flow. You then document illustrative examples to bring each principle to life. Under risk control. You recount the time you avoided a popular fintech stock that collapsed, crediting your position sizing rule for saving your gains. For value, you describe buying a beaten-down retailer ahead of its turnaround, proving that low expectations seed outsized returns. Under contrarian thinking, you recall shorting a bubble-priced biotech before its clinical trial failure made headlines. For asymmetry, you detail selling covered calls on a stable utility, generating income regardless of minor price fluctuations. Each memory reinforces why the principle matters. That process deepens your conviction. You see how these rules emerged not from abstract theory, but from real-world triumphs and setbacks. You realize that your creed is uniquely yours. It weaves together insights from legends with your particular risk tolerance, time horizon, and areas of expertise. No one else's playbook fits you perfectly, and that's precisely the point. With your creed drafted, you decide to make it public, at least to yourself. You pin it above your workspace, where it's visible during every trading session. You also create a digital copy in a folder titled Investment Philosophy, so you can easily revisit and update it. Whenever you face a tough call, like whether to add to a position amid market turmoil, you glance at your creed and ask, which tenet speaks to this situation? That instant refocuses your mind on principles over impulses. To embed this creed in your workflow, you build a simple checklist in your trading journal. Before each trade, you run through 6 questions corresponding to your tenets. Does this position align with my risk control threshold? Am I paying less than my conservative value estimate? What contrarian insight am I acting on? Where is the asymmetry in upside versus downside? How does randomness factor into my probability distribution? Does this idea fit within my evolving framework? If any answer feels shaky, you pause the trade and reassess. This ritual ensures that every dollar you invest resonates with your philosophy, minimizing regrets and chronic indecision. You also schedule monthly philosophy sessions on your calendar, a half hour where you review your creed, log key lessons, and identify where you strayed. Did you chase momentum contrary to your value rule? Did you neglect a hedge that could have saved a loss? Did you ignore a catalyst that proved critical? You capture these insights in a Lessons Learned section, which informs the next quarterly update of your creed. Over time, this living document evolves. You tweak wording, add new examples, refine tenets, and adjust guidelines. Perhaps you raise your stop-loss band to reflect increased market volatility, or tighten your diversification targets based on observed correlation spikes. Each iteration sharpens your edge and reinforces your commitment. Importantly, your creed also includes a humility clause. I recognize that my philosophy is imperfect and that markets will surprise me. I will revise my creed when evidence demands change, not opinion. This bullet keeps you honest and nimble, preventing the arrogance that turns wisdom into dogma. With your personal philosophy firmly in place, you feel an unusual calm. Market news no longer hijacks your emotions. You remain anchored. When a stock doubles overnight, you assess whether it still fits your rules instead of riding an adrenaline rush. When a flash crash triggers buy the dip headlines, you slide your checklist into action, confirming that fundamentals hold before diving in. Your philosophy becomes the lens through which you view every opportunity and challenge. It's more than a list of do's and don'ts. It's a mindset that permeates your approach, from the smallest intraday fluctuations to long-term asset allocation decisions. It guides you when data is scarce, when models conflict, and when the inevitable uncertainty of markets looms large. By defining, documenting, and living your investing philosophy, you transform yourself from a reactive trader into a disciplined steward of capital. You move with purpose, informed by the best lessons of market legends and your own experiences. You stand ready to adapt when necessary, yet grounded in principles that have withstood market cycles and personal trials. As you close your journal, look up at your creed pinned on the wall. Each line represents not only knowledge, but commitment to yourself and to the path you've chosen. In moments when markets roar unpredictably, that creed will be your guide, your shield, and your compass, ensuring that every decision you make reflects the core of who you are as an investor. You rise each morning knowing your creed, but true mastery comes when you live its pillars in every decision. These 6 pillars: risk control, value over hype, contrarian conviction, asymmetry, probabilistic tilt, and continuous evolution aren't abstract slogans. They're action guides that shape how you research, size, and manage every position, ensuring consistent results through bull and bear cycles alike. Must rep: risk control above alls. Every time you consider a new idea, you begin with the question, if this turns wrong, how much damage will it do? You never shortcut this step. You size positions so that even a 30% loss leaves your core capital intact. You set stop-loss levels wide enough to avoid noise, but tight enough to cap bleeding. When volatility spikes, you reduce exposure rather than chase returns. Over months and years, this discipline keeps you in the game, protecting gains and giving compounding the runway it needs. 2. Embrace value over hype. You resist the allure of viral tickers and celebrity endorsements. Instead, you hunt for mispriced gems, companies trading significantly below your conservative intrinsic value estimate. You've seen the power of margin of safety firsthand. Buying that beaten-down retailer before its rebound, snapping up quietly profitable small caps ignored by algorithms. You calibrate value metrics, PE, free cash flow yield, net asset backings, and buy only when price leaves room for error. That gap between price and worth becomes your launch pad for gains. Now 3. Think contrarian with conviction. When everyone rallies behind a sector, you quietly probe its assumptions. Have all positives already been priced in? What risks are being ignored? You develop a consensus radar that alerts you when sentiment extremes emerge, both euphoria and despair. If gasoline stocks crater amid recession fears, you dig into inventory drawdowns and global demand forecasts. If they're oversold relative to fundamentals, you deploy capital. Contrarian thinking isn't reactionary. It's calculated dissent based on rigorous analysis and unwavering conviction. 4. Lean into asymmetry. You prioritize opportunities where downside is limited, but upside is significant. That could mean selling covered calls all blue chip stocks to generate steady income. Buying deep in the money puts as portfolio insurance, or allocating to high-yield bonds trading at historic spreads. You size each asymmetrical play so that occasional losses feel like tuition, small, manageable, and occasional wins feel like windfalls. Over time, these positively skewed outcomes transform your return profile from ordinary to exceptional. Met 5. Accept randomness. Tilt odds. You accept that luck plays a role, so you structure decisions around probabilities. Before every trade, you sketch worst case, a base case, and best case scenarios, assigning rough probabilities. You avoid bets where a low probability disaster wipes out years of gains. No matter how enticing the best case, you overweight ideas where modest downside meets outsized potential, like selling puts on dividend stalwarts or buying discounted cyclicals at cycle lows. By tilting odds in your favor, you let skill dictate results over time. Net 6. Evolve continuously. Your philosophy isn't set in stone. It's a living document. Each quarter, you hold a philosophy review. You revisit the creed, log lessons from wins and losses, and update guidelines. Maybe you tighten stop-loss bands after a frustrating drawdown. Maybe you expand your high-yield playbook to include emerging market credits. You document new insights, how certain catalysts panned out, which stress tests failed, which biases tripped you up. This iterative evolution keeps your approach sharp and adaptable to new market regimes. These pillars interlock. Risk control tempers your asymmetrical bets. Value over hype guides your contrarian conviction. Probabilistic tilt refines your stop-loss rules. Continuous evolution ensures you learn when randomness blindsides you. For instance, when a stock you love surges 50% on a rumor, contrarian conviction urges caution. Value over hype checks whether price still leaves room. And risk control sets clear exit criteria. That synergy prevents single-point failure and fosters consistency. To internalize these pillars, you embed them in daily rituals. Pre-trade checklist. For any idea, run through 6 bullet point questions tied to each pillar. If any answer raises doubt, pause until clarity emerges. Morning risk. Brief. You scan portfolio exposures against macro shifts, volatility readings, and sector sentiment extremes, ensuring your risk control and probabilistic tilt remain aligned. Weekly reflection. You journal one example of each pillar in action, whether trimming a position, risk control, snapping up a value play, questioning consensus, executing an asymmetrical strategy, weighing odds, or adapting a rule. This practice cements habits. You also share your pillars with trusted peers, inviting feedback. When you explain why you sold a hot momentum stock because it violated your value over hype rule, they nod in recognition. Teaching these concepts not only strengthens your own understanding, but recruits accountability. You're more likely to follow through when your rationale is public. In volatile markets, these pillars prove their worth. When the next tech bubble inflates, you don't chase. Your value and contrarian filters flag excessive multiples and sentiment mania. When a global shock triggers panic sellings, your asymmetry and probabilistic tilt guide you to opportunistic entries, while risk control ensures you don't overextend throughout. Continuous evolution helps you download fresh insights into emerging sectors or novel hedging instruments. Over time, your portfolio becomes a reflection of these 6 pillars. It weathers storms, capitalizes on dislocations, and maintains steady compounding without the wild swings that derail many investors. You notice your own confidence growing, not from arrogance, but from knowing every decision aligns with principles forged from study, experience, and structured self-reflection. You've turned wisdom into workflows. These 6 pillars aren't lofty ideals. They're practical navigational tools that guide every click, every trade, and every portfolio rebalance. They ensure you remain disciplined when markets tempt you to stray, and nimble when circumstances demand adaptation. As you wrap this section, take a moment to breathe. Glance at your creed on the wall. Feel the quiet assurance that comes from knowing you have a roadmap. 6 sturdy pillars that support your journey through uncertainty. With them as your foundation, you're not just reacting to markets. You're leading your own path towards sustainable and consistently profitable investing. You settle into your favorite chair as dawn's first light filters through the window, and you reflect on how your 6 pillars play out in the real world, through market booms, crashes, and every twist in between. These stories from the trenches prove that your philosophy isn't just theory. It's battle-tested wisdom that shines brightest when conditions get toughest. .com mania and the art of avoidance. It's late 1999, and you watch the NASDAQ soar above 4,000. Headlines trumpet new era technology companies with no profits growing at warp speed. You feel the pull, after all. What if the next Amazon or Google hides among those .com darlings? Yet your value over hype pillar rings alarm bells. Companies trading at 100x revenue with a negative cash flow leave zero margin for error. You test a handful of these names against your discounted cash flow model and find gaping holes. A recipe for catastrophic loss if growth falters. And so, you resist the frenzy. Instead, you rotate into a handful of established tech firms trading at reasonable multiples, and you hedge your exposure with out-of-the-money puts on an equal-weighted tech ETF. When the bubble inevitably bursts in early 2000, your defensive position, sizing, and hedging strategies limit losses to single digits, while momentum-chasing investors watch their portfolios implode. Your portfolio weathers the storm, primed for the next recovery. 2008, financial crisis and probabilistic protection. Fast forward to late 2007, housing starts falter. Credit spreads widen, and whispers of subprime woes intensify. Your macro framework registers red flags, mortgage delinquencies ticking up, lenders tightening standards, and credit default swap volumes spiking. You recall Taleb's lessons on randomness and anti-fragility, so you size down your equity exposure, lock in profits on cyclical names, and allocate more to high-quality treasury bonds. Your risk control rule overrides your thirst for gains. In January 2008, you also initiate a modest long-tail hedge by buying out of the money index puts, paying a small premium for peace of mind. When Lehman collapses in September, markets vaporize nearly 40% of value across sectors. Your portfolio, however, drops only 12%, thanks to defensive diversification and your probabilistic tilt toward safety. The modest cost of your put hedges pays off, offsetting losses in equities as panicked investors scramble for the exits and liquidity evaporates. You calmly tape new cash to your screen, opportunity fund ready. You deploy capital into undervalued bank stocks and corporate bonds trading at historic spreads, guided by your value and asymmetry pillars. Within 18 months, as markets recover, your patient entries reap triple-digit returns, illustrating how disciplined defense creates the capacity for outsized offense. 2011, Eurozone shock and contrarian courage. In mid-2011, the Eurozone spirals amid sovereign debt fears. Headlines scream Grexit. Credit default swap spreads on peripheral nations soar, and equity markets whipsaw. You monitor your company-level stress tests. You own a global consumer goods giant whose European sales dipped 10%, but whose balance sheet remains rock solid. While peers abandon ship, you increase your position. As long as the pessimistic case doesn't breach your downside tolerance, you're all in. That contrarian move pays off in the next quarter, when the company reports resilient margins and an aggressive share buyback program, catalyzing a 25% rally. Your contrarian conviction capitalizes on collective fear, proving that standing firm when others flee can unlock rapid gains. 2020. COVID crash and asymmetric opportunity early 2020 brings the unthinkable. A novel coronavirus sweeps the globe. Global markets free fall, with major indices plunging over 30% in weeks. The panic is deafening. Yet your philosophy session and pre-trade checklist kick in. You evaluate your core holdings against the three scenarios: base case, pessimistic, optimistic, and find that several high-quality tech and healthcare names, though beaten down, still boast long-term growth drivers. You also scan for high-yield opportunities. Cruise line bonds trade at yields above 20%, and you identify companies with strong liquidity and government backstops. You invest modestly in these fallen angels, sizing small given the uncertainty. As central banks unleash unprecedented stimulus and economies reopen, your tech and healthcare picks rebound swiftly, while your high-yield cruise bonds rally from 50C on the dollar back to 85C. Your asymmetrical approach, limited downside by selecting firms with survival capacity and significant upside when conditions normalize, translates into annualized returns north of 40% for the year. Other investors, traumatized by the crash, miss the recovery. You embody the principle that market chaos often conceals your next opportunity. 2021, meme stock mania and disciplined boundaries. Come early 2021, Reddit-fueled swings thrust meme stocks into the spotlight. Retail investors catapult tiny float names to triple-digit gains. Your contrarian conviction kicks in. If a stock owned by a handful of retail accounts and trading at 100x book value surges 80% in a day, you don't buy, you either short or steer clear. You log a small put position on a representative meme name, guided by your rule against exuberance. As short squeezes intensify, your hedge briefly goes underwater, but you hold. Trusting risk control keeps your size manageable. When the mania deflates, your put position pays off handsomely, while momentum chasers suffer steep losses. That episode reinforces your commitment to value over hype and discipline in the face of crowd contagion. 2022, inflation surge and yield discipline. In 2022, inflation spikes to 4-decade highs, bond yields climb, and rate-sensitive tech stocks tumble. Your morning risk brief flags widening spreads and a clear regime shift. You rotate into floating rate debt, preferring bank loans and senior secured bonds that reset yields with inflation. You also trim long-duration equities, redeploying into energy and commodity producers, trading at undemanding multiples. As central banks hike rates, your floating rate allocations generate rising income, and your energy picks surge with commodity prices. While traditional bond investors suffer, your defensive value and asymmetry playbook harnesses the inflationary regime to your advantage. 2023, emerging market dislocations and deep value. emerging markets wobble amid global tightening, currency volatility, and political headwinds. Many institutional investors retreat, deeming the risk too high. You recall your philosophy. Lean into fear when fundamentals hold. You focus on select Asian exporters with strong export pipelines and governments that support strategic industries. You hedge currency risk modestly via options and position in equities trading at significant discounts to book value. When global growth revisits emerging Asia in late 2023, your positions rebound 30 to 50%, outpacing both US and global indices. That win cements your belief. Crises often beget pockets of opportunity for those who act thoughtfully. Lessons woven into practice. Each of these stories underscores how your pillars interlace in practice. Defensive risk control saved you from dot-com vapors and 2008 eerie free falls. Value, overhype, steered you clear of unsustainable rallies. Contrarian conviction unlocked gains during Eurozone panic and COVID distress. Asymmetry and probabilistic tilt propelled your high yield and post-crash recoveries. Continuous evolution kept you nimble, refining your tactics for inflation regimes and emerging market turns. These anecdotes aren't isolated victories. They form a tapestry of trial and triumph. You've seen how theory transforms into action, how principles born from past legends guide you through new frontiers, and how your own wins and losses refine your judgment. You don't boast of being right every time. You celebrate having the framework to survive errors and capitalize when your edge emerges. As you close this chapter of stories, feel the confidence that comes from knowing your philosophy works in the heat of real markets, not just on paper. These battles, from dot-com nightmares to meme stock frenzies, have tested your pillars, and they've held strong. You're not invincible, but with each trial, your framework grows more resilient, more finely tuned, and more reliable. You've navigated value traps, mastered asymmetry, and honed your contrarian edge. But the real test is sustaining that edge over decades. In this chapter, you'll internalize 3 timeless adages, pearls of wisdom forged in market fires, and learn how invoking them at critical moments keeps you humble, vigilant, and ultimately successful. Adage 1. What the wise man does in the beginning, the fool does in the end. You hear that and imagine 2 investors at opposite sides of a seesaw. The wise investor spots an emerging trend early, say a solid company launching a breakthrough product at an undemanding valuation, and takes a quiet position before Wall Street applause arrives. The fool, dazzled by headlines and late-cycle euphoria, piles in at the peak, chasing momentum with no margin of safety. When the inevitable correction hits, the early entrant reaps the rewards, while the latecomer watches gains vanish. You experienced this firsthand during the rollout of electric vehicles in the late 2010s. You notice established automakers investing heavily in battery technology and identify a quality battery materials company trading at a reasonable multiple. You initiate a position before the EV revolution becomes mainstream. Years later, when the headlines blare partnerships and production targets, that stock has already multiplied several times. Meanwhile, speculators chasing the latest EV meme stall find themselves nursing losses as the euphoria fades. You smile, recalling that adage, your early reasoned decision becomes your compass, while hindsight confirms the folly of buying at the crest. Invoking this adage means you resist the fear of missing out. You monitor nascent trends with a discerning eye, but you wait for your own confirmation, solid fundamentals, credible catalysts, and margin of safety before committing capital. You understand that early participation grants superior returns, but only when grounded in robust analysis. The moment you catch yourself chasing a story after it's splashed across every ticker, you pause and remember, the wise have already moved on, while the fool rushes in at the end. Adage 2. Never forget the 6-foot-tall man who drowned crossing a stream that was 5 feet deep on average. This vivid image stays with you. Statistics lie when they mask dangerous extremes. Averaging stream depth to 5 feet ignores deeper, perilous spots. Similarly, focusing on average returns or historical volatility can lull you into complacency. You remind yourself that you need to survive the worst days, not just the average ones. You internalize this principle in your position sizing rules. When you evaluate a stock's historical drawdowns, you don't just look at average annual dips. You examine the deepest troughs, the extreme 2008 style crashes, the panics of 2020. If a company's shares collapsed 80% during a crisis, you test whether your balance sheet, covenant protections, or portfolio size would withstand such an event. If not, you adjust your position size or impose hedges. You know that surviving the worst days is non-negotiable. Compounding only favors you if you remain in the game. That adage also shapes your diversification approach. You don't count on correlation remaining stable because history tells you it won't. In crisis, assets that seemed uncorrelated can suddenly fall in lockstep. You manage this risk by incorporating liquid alternatives like managed futures or market-neutral strategies that thrive when traditional assets falter. You allocate to defensive sectors, maintain cash buffers, and keep tail hedges small but effective. Each layer of protection acknowledges that average outcomes are irrelevant if extreme events can wipe you out. When you review your portfolio after a brutal sell-off, you recognize that your adherence to survive the worst is what kept you upright. While many investors succumbed to forced selling, you held positions that had both fundamental resilience and prudent size. Your balance sheet may have shown a paper loss, but you never breached your worst-case thresholds. That calm and the margin of safety you built became your greatest ally. Adage 3. Being too far ahead of your time is indistinguishable from being wrong. You've spotted transformative trends, cloud computing, genomics, artificial intelligence, years before broad adoption. You position early into knowing the long runway ahead. Yet time alone can sink your returns. Lucky winners must wait years for adoption curves to steepen. If the market doesn't catch on, you risk opportunity cost or even capital erosion from carrying costs like hedges or margin. You recall investing in solar energy stocks in the early 2010s. You understood the long-term shift toward renewables, but missed that early governmental incentives faded quickly, and module prices hadn't yet reached grid parity. Despite holding positions in promising names, you watched patience turn into frustration as trade disputes and regulatory checks failed to materialize. You exited positions at a minor profit after several years, chastened by the weight of carrying costs and capital tied up in slow-burn trades. This adage teaches you timing matters. You still identify long horizon themes, but you calibrate your time horizon and position size accordingly. If you believe a technology needs 10 years to reach mass adoption, you limit size and factor in carry costs, lost opportunity to invest in shorter cycle opportunities. You set periodic checkpoints. If adoption milestones aren't met by year 3, you reevaluate. You balance conviction with pragmatism, ensuring that being early doesn't become a clinching defeat. You also apply this lesson to macro cycle bets. When you forecast a shift in interest rate regimes or demographic trends, you set clear timing boundaries. If rates aren't rising within a predefined window, you lighten exposure, recognizing that being right but early can still be unprofitable. This discipline ensures that firm convictions don't calcify into stubborn biases, cultivating modesty and humility. These three adages converge on a common theme: humility. You don't claim omniscience, and you don't feign invulnerability. Instead, you cultivate modesty, knowing that you can be right in idea and wrong in timing, that averages mislead, and that the crowd often moves before and after moments when you think uniquely. You practice intellectual humility by welcoming disconfirming information. When data contradicts your thesis, you don't rationalize, you question your assumptions. You set up devil's advocacy sessions in your journal. You write down why your idea could fail, what 3 facts would force you to exit, and you revisit those conditions regularly. This habit protects you from pride-driven blind spots. Humility also means crediting luck. When an early entry pays off ahead of schedule, you thank both your analysis and the role of favorable timing. You avoid attributing success solely to skill, and you use those wins to reinforce your defensive frameworks, not to inflate your ego. Finally, humility fuels continuous learning. You read widely: history, psychology, economics, and you engage with peers who challenge your views. You dissect failures in your lessons learned log, extracting whether they stemmed from analysis flaws, timing miscalculations, or pure randomness. Each lesson refines your approach, ensuring that your philosophy doesn't ossify into dogma. Taking these adages to heart. To embed these adages in your daily workflow, you create simple prompts. Before initiating any position, ask, am I too late to capture value or too early to enjoy growth? Wise man versus erring fool. As you monitor portfolio metrics, pause and reflect. Does this average return mask extreme vulnerabilities? Stream depth. When you educate peers or mentor others, share these stories to reinforce the mindset that timing, risk awareness, and humility define success more than raw insight. You also incorporate these adages into your philosophy review ritual. Each quarter, you review past decisions through the lens of these 3 adages, rating your adherence and noting improvements. You document when being early cost you returns, when average measures hidden tail risks, and when you rode early insight wisely or foolishly. Over time, these 3 adages become neural shortcuts, automatic reminders that guide your instincts when markets roar. When you sense euphoria, you recall a beginning from its end. When you encounter smooth averages, you recall drowning streams. When you position for distant trends, you recall ahead verbers wrong. These mental triggers keep you grounded, preventing overreach and reinforcing disciplined action. By honoring these timeless investment maxims, you weave an additional layer of wisdom into your philosophy. You balance eagerness to act with prudence, embrace the reality of extremes, and temper vision with practical timing. In doing so, you fortify your journey, ensuring that your long-term success isn't undone by avoidable missteps or undue hubris. You lean forward as your phone buzzes with a new notification. Is an index fund enough for me? When should I time the market? What catalyst should I wait for? How did Oaktree convince clients in the early days? Are markets overvalued today? you realize that clarity comes not from separate silos of knowledge, but from weaving these questions into your core philosophy. Let's unravel these dilemmas, answering them in your second-person narrative, so you can apply each insight to your journey. Is an index fund enough for you? You've heard the rallying cry, just buy an index fund. Beating the market is impossible. That's partly true. Most active managers fail to outperform after fees, and amateurs often derail their own performance by chasing hot tips. Yet you also know index funds carry market risk. When broad indices crash, you feel the pain. So you ask yourself, what do I seek? Simplicity or outperformance? If your goal is broad exposure, low fees and minimal maintenance, an index fund can serve as the backbone of your portfolio. You automate contributions, set it, and forget it, letting compounding work its magic over decades. But if you crave additional edge, your philosophy nudges you towards supplementing index exposure with selectively chosen positions that align with your 6 pillars. A handful of undervalued stocks, high-yield bonds, or asymmetrical option plays. That way, you maintain core market exposure while tilting odds in your favor. In practice, you allocate perhaps 60-70% to low-cost index funds and the remaining 30-40% to your active ideas. You monitor performance and rebalance. If your active sleeve outperforms, you take profits and rebalance into the index. If it underperforms, but still meets your criteria, you hold through market cycles until catalysts emerge. This hybrid approach blends the simplicity of passive with the upside tilt of active, anchored in risk control and value discipline. When should you time the market? You've tried to predict tops and bottoms, only to find timing is notoriously elusive. Yet your macro framework and scenario analysis reveal inflection points where rebalancing makes sense. You ask, do I believe markets are at an extreme valuation that justifies reducing equity exposure? Instead of daily timing, you adopt 2 complementary strategies. First, you use valuation thresholds. When the Shiller P/E ratio climbs above 30, significantly above its long-term average, you trim your equity allocation by a predetermined percentage, shifting into bonds or cash. Conversely, when it falls below 15, you redeploy into equities. These wide ranges prevent overtrading, honor margin of safety, and respect extreme events. Second, you employ systematic rebalancing. You set quarterly check-ins to restore your target allocation between equities and fixed income. In bull runs, you naturally trim winners. In bear markets, you buy more equities at lower prices. This disciplined rhythm lets you capture gains and buy dips without relying on perfect forecasts. Over decades, this blend of valuation-based tilts and mechanical rebalancing compounds into superior risk-adjusted returns and compared to buy and hold alone. What catalysts should you wait for? You've studied your checklist: balance sheet triggers, management milestones, regulatory approvals, mergers and acquisitions. But you ask, which catalyst reliably bridges the gap between price and value? Not every pending event warrants action. You narrow your focus to catalysts that, re-EA, materially impact cash flows or strategic direction, and B, fall within a realistic time frame. For example, you hold a biotech stock pending FDA approval. You know that an approval could double revenue, while a rejection could sink the share price by half. That binary outcome meets your asymmetry criteria: limited downside if you size small and significant upside if the trial succeeds. You enter at a level that reflects these probabilities. When the PDUFA date arrives, you align your position with the outcome. If the review is delayed, you reassess whether to hold or exit based on the updated timeline. If the drug is approved, you lock gains. If it's rejected, you trim losses swiftly. Similarly, for cyclical companies, you identify macro catalysts, interest rate cuts, commodity price troughs, or inventory rebuilds that historically coincide with earnings recoveries. You study sector cycles in depth to time your entries and exits. That combination of fundamental event-driven and cyclical catalysts helps you allocate capital where and when it matters most. How did Oaktree convince early clients? You imagine the challenge. In the late 90s, few institutional investors entertained high-yield bonds or distressed debt. You ask yourself, what can I learn from Oaktree's early story? The answer lies in clear communication, credible track record, and aligned incentives. Oaktree founders didn't bombard prospects with jargon. They explained the negative art principle. Returns come not from choosing among performing bonds, but from excluding those likely to default. They used simple diagrams, bell curves showing asymmetry between investment grade and high yield spreads, to illustrate how yields compress on survivors. Then they showcased back-tested numbers, demonstrating how credit spreads above 1,000 basis points historically delivered double-digit yields with limited realized losses. Equally important, they structured fees to align incentives, no front-loaded fees, but performance-based compensation that rewarded downside protection as much as upside capture. That meaningful alignment engendered trust. You adopt a similar approach. Whenever you pitch an idea, even to yourself, focus on clarity, concrete examples, and aligned outcomes. You explain worst-case scenarios, potential upsides, and how you'll manage risk. That transparency cements conviction and accountability. Are markets overvalued today? You glance at headlines. S&P 500 trades at record PE. Tech stocks soar. Cryptomania returns. You ask, should I batten down the hatches? Your philosophy prompts you to assess true valuation rather than headline multiples alone. You calculate equity risk premium, expected market return minus current treasury yield, and compare it to historical averages. If the premium compresses far below long-term norms, you tilt towards defensive positions. You also examine median PE, cyclically adjusted metrics, corporate bond spreads, and equity risk premia across regions. You note that U.S. valuations remain elevated relative to history and global peers, suggesting cautious stance. Yet pockets of opportunity exist in beaten-down sectors, emerging markets, small caps, or cyclical undervaluations, where your value and asymmetry pillars guide you. You set to regime conditions. If the equity premium falls below 2% and breadth measures roll over, EEGG, fewer than 50% of stocks trading above their 200-day moving average, you reduce core equity exposure by 20%. Conversely, if premium rises above 6% and breadth collapses below 30%, you redeploy 20% back into equities. Because these actions stem from a rules-based framework tied to valuation and breadth. You avoid panicked overreaction or paralyzing inaction by integrating current valuations into your macro and micro filters. You remain neither doom and gloom nor blindly optimistic. You maintain a balanced and dynamic exposure that responds to genuine shifts in value and sentiment, rather than chasing headlines. Bringing it all together. These Q&A dilemmas, index funds version, active, timing, catalysts, firm building, evaluations aren't disparate challenges. They're threads woven into your philosophy's tapestry. When you ponder whether an index fund suffices, you see how risk control and value over hype inform a hybrid allocation. When market timing lures you, you recall your probabilistic tilt toward safety and mechanical rebalancing rules. When catalysts beckon, you apply your checklist and sizing principles. When reflecting on early oak tree stories, you learn the power of simple communication and aligned incentives. When evaluating market valuations, you set objective thresholds that trigger disciplined action. Each answer reinforces that you are never trading blind or reacting emotionally. You're following a coherent framework, one you built from timeless lessons, personal trials, and structured self-reflection. This integrated approach protects you from common pitfalls and guides you toward opportunities that fit your criteria. So the next time your mind buzzes with these questions, pause and revisit your pillars. Is this consistent with my hybrid passive-active allocation? Does this move fit my timing rules? What catalysts truly matter for this position? Am I communicating my rationale clearly, internally, or to others? Do current valuations justify action or restraint? By folding these Q&A dilemmas into your daily process, you solidify your philosophy's practical power. You're not just answering questions, you're reinforcing the habits that enable you to act decisively, calmly, and profitably in any market environment. You stand at the threshold of your next investing chapter, armed with a living philosophy, battle-tested pillars, and a toolkit of strategies. Now comes the final step, transforming knowledge into consistent action. This section guides you through practical next steps, daily habits, weekly rituals, and long-term milestones that ensure you apply everything you've learned and keep evolving towards your wealth goals. 1. Set up your command center. You need a dedicated space, physical or digital, where you house all your essential resources on your desktop or tablet. Create a folder labeled Investing Toolkit. Inside, store your personal creed, 6-pillar checklist, macro framework template, and scenario analysis spreadsheets. Bookmark key websites, financial statement databases, central bank calendars, and industry news portals. Physically, arrange your workspace with your journal open, your philosophy pinned to the wall, and a charting application ready. This command center becomes your cockpit. Everything you need for informed, disciplined decisions is at your fingertips. Chatuner, establish daily morning and afternoon briefings. Consistency fuels discipline. Every trading day, carve out 2 brief windows, a 15-minute morning brief at market open, and a 10-minute afternoon check at mid-session. In the morning brief, scan your high-priority indicators, major index futures, bond yields, credit spreads, and any overnight geopolitical or economic headlines. Note any deviations from your macro framework thresholds. In the afternoon check, revisit any positions showing extreme volatility or approaching your stop-loss bands. Record observations in your trading journal, answering 2 questions. What surprised me today? And what am I monitoring tomorrow? These rituals keep you responsive without reactive. Mamandari. Use a structured pre-trade checklist. Before initiating any new position or adding to an existing one, run through your 6-pillar checklist. Draft a 1-page pre-trade note that answers, how does this position align with my risk control limits? Does the current price offer adequate margin of safety? What consensus view am I challenging? And why? Where is the asymmetry between upside and downside? What is my probability distribution across scenarios? How does this idea fit Mises' evolving philosophy? If you can answer each succinctly, you postpone the trade and refine your analysis. 4. Schedule weekly market deep dives. Pick consistent time each week, perhaps Friday afternoon, for a 30-minute deep dive. Rotate focus among 3 domains: company fundamentals, sector trends, and macro market outlook. For fundamental, update your stress tests and check for any new filings or earnings reports. For sectors, examine trend charts, sentiment surveys, and regulatory news. For the macro outlook, revisit your 6 to 8 key indicators and assess any regime shifts. Conclude each session by noting 2 action items: 1 tactical, tighten a stop loss and trim a position, and 1 strategic, e.g., research a new industry, adjust target allocations. 5. Hold quarterly philosophy review summits. Every 3 months, block out 60 to 90 minutes for a deep philosophy review. Revisit your personal creed, your lessons learned log, and any deviations you recorded. Ask, which principles guided my best wins? Which oversights caused losses? Update your philosophy document accordingly, tweaking tenets, adjusting thresholds, refining checklists. Reflect on personal growth. Have your emotional reactions become more calibrated? Have you added new tools or eliminated outdated ones? These quarterly summits ensure your philosophy remains alive, responsive to new lessons, and impervious to stale habits. Maker 6. Maintain a lessons learned journal. Complement your trading journal with a separate lessons learned section. For every position you close, whether profitable or not, write a 1-page analysis. Entry rationale, outcome, what worked, what failed, and how you will adjust next time. Tag each entry by the relevant pillar or principle. Over months, patterns emerge. Perhaps you notice you repeatedly underestimated catalysts or misread management credibility. These insights feed directly into your philosophy reviews and help you eliminate recurring errors. 7. Develop a networking and accountability group investing in isolation risks echo chambers. Seek out a small group of like-minded investors, colleagues, friends, or online peers who share a commitment to disciplined, principle-based decision-making. Hold monthly video calls or in-person meetups and to discuss new ideas. Challenge each other's assumptions and review difficult calls. Peer accountability keeps you honest. You'll think twice before straying from your creed. If you know you'll have to explain it, shared wisdom also exposes you to fresh perspectives and market insights you might otherwise miss. 8. Automate the mundane, free up mental bandwidth for analysis by automating routine tasks. Set up auto-invest plans for your index fund allocations, schedule quarterly ETF or sector rebalances, and use price alerts for key stop-loss levels. Automate data collection. Use scripts or apps to pull in earnings releases, economic calendar reminders, and credit spread updates. With the mundane handled, your energy stays focused on high-value activities, deep research, scenario planning, and strategic adjustments. And 9. Invest in continuous learning. Markets evolve, and so must you. Allocate time each week, perhaps an hour on weekends, to read widely. Biographies of legendary investors, behavioral finance research, sector white papers, and economic history. Subscribe to a handful of high-quality newsletters or podcasts that probe market anomalies and investing ideas. Attend webinars or local investment conferences when feasible. You're not chasing every trend. You're selectively enriching your mental models and expanding your playbook. Establish clear milestones and metrics. Define your long-term goals, targeted compound annual growth rate, risk-adjusted return benchmarks, or any personal outcome like funding education or retirement. Then break these into yearly, quarterly, and monthly metrics: portfolio return versus benchmark, maximum drawdown avoided, number of new high-conviction ideas ranked by your checklist. Review these metrics in your philosophy reviews and adjust as needed. Clear milestones keep you oriented toward purpose, not vanity metrics or emotional reactions. 11. Cultivate emotional awareness. Even the best systems fail if emotions hijack your judgment. Build in short, pause rituals when you feel anxiety or euphoria. Take 3 deep breaths, step away for a minute, and revisit your creed's guiding phrases. Consider adding brief mindfulness or journaling exercises to observe your emotional state without judgment. Over time, you recognize patterns. Maybe you're risk-seeking after a winning streak or overly cautious after a loss, and you can counteract these biases proactively. 12. Review and refine asset allocation annually. Once a year, step back and reassess your overall asset allocation. Evaluate whether your mix of equities, fixed income, alternatives, and cash still aligns with your risk tolerance, life stage, and market outlook. Use your valuation filters and macro framework to guide tweaks, perhaps shifting toward shorter duration bonds in a rising rate environment, or adding emerging market exposure when valuations become compelling. Annual reviews ensure your portfolio remains aligned with both your long-term goals and your evolving philosophy. By weaving these next steps into your daily, weekly, quarterly, and annual routines, you transform abstract principles into living habits. You free yourself from reactive chaos and instead embrace a structured path toward wealth accumulation. Every task, no matter how small, reinforces your philosophy, hones your edge, and builds the confidence necessary to navigate any market environment. Take a moment now to draft your own action plan based on these steps. Identify your command center, schedule your rituals, and list your first 3 implementation tasks. Then, commit to starting immediately, because the journey to wealth won't wait for a perfect moment. You've traveled a long path, from reframing how you view stocks, to mastering value, contrarian thinking, and probabilistic risk control, all the way through to real-world anecdotes and timeless maxims. Now it's time to pause and let these insights settle like gentle ripples across a calm lake. Take a deep breath. Feel the slow rhythm of your heartbeat as you reflect on your newfound philosophy. Notice the quiet reassurance that comes from having concrete principles to guide you, rather than fleeting emotions or sensational headlines. Recognize that wealth building is rarely a sudden sprint. It's a steady stride, each step grounded in thoughtful analysis and disciplined action. Imagine your future self looking back, grateful you laid this foundation. Picture the relief of knowing that when markets wobble, you have protocols to navigate turbulence. Envision the satisfaction of spotting opportunities where others see only despair or hype. Trust that each routine you establish, your daily briefs, your pre-trade checklist, your quarterly summits, cements your path forward, building habits that multiply into lasting success. As you ease out of this session, carry these words with you. Survival is victory. Buy when optimism wanes. Respect chance. Manage outcomes. Let them echo softly in your mind when uncertainty creeps in, guiding your actions with calm clarity. The world of markets may feel unpredictable, but your approach isn't, because you've crafted a living philosophy, honed a resilient mindset, and built a framework that adapts and endures. Each day you invest, each lesson you record, and each ritual you honor nourishes your growth, like gentle sunlight nurturing new shoots. Go forward now with confidence and humility, ready to embrace both challenges and opportunities. Your path ahead isn't defined by fear or impulse, but by purpose, discipline, and the unwavering belief that through thoughtful investing, anyone can forge real wealth. Wish you can do it soon.